Hey, everybody. Welcome to EverydayFI, the podcast that explores the lives and stories of everyday people in the financial independence community. Today, Mitch and I are going to chat about the most recent market craziness. I don't know if you guys have noticed the news or anything. Something's going on in the market. And you get to see our faces because this is the first time I'm going to put our faces on YouTube. And hopefully it goes well. I am definitely a lot more nervous than I normally am, because you can actually see my expressions when I'm talking, which is going to be interesting. But hey, Mitch, how you doing?
I'm great. And I think it's really cool that just as we started chatting, we learned that this is episode numero 50. That's exciting. Congrats on that. We did not plan this. It's just what happened because the market spoke and we chose to take action this week instead of our normal cadence. So thanks for having me. Congrats on making it to 50. That's a huge accomplishment. And yeah, I'm excited to chat about all this.
Yeah, thanks so much. Yeah, I can't believe it's been 50. It's, it was about a year ago that I started it. I think I started May 1st, and today is April 10th, I believe. So almost a year. So, man, it's been a whirlwind. I love doing this show, and I can't wait to do more, and I can't wait to get some more videos out there. But yeah, let's talk about what's going on in the market right now. And it's funny because when you and I decided to do this episode, the market was like tanking,
Mm-hmm.
and we were like, should we buy in? And now the market's like back up 9%, and then it went down a little bit again. So what was your initial reaction to the market just taking a nosedive?
Yeah, it's a little wild. And the timing's really funny because I've made it pretty clear I hit FI technically this last summer once I reached this sale and exit point from my former company. And I actually just received my final payment this week. So you and I have been texting a lot about how the timing of this is insane and when that money hit my account to be able to invest it. And my initial thoughts are different, I think, than they would have been a few years ago, but I'm not 100% sure. So I think part of what's hitting me, if I'm being honest, is there's some people in the community that are pretty loud and they're considering, hey, maybe all equities isn't the answer anymore. Maybe we should shift to some bonds. Maybe we should lock in our win. And I'd be lying if I said that hadn't informed me a little bit. And while that kind of noise was going on, the market was down 8 to 10%. And then when it tanked, I'm used to just being like, buy, buy, buy as fast as possible. And while I still think I leaned that way, I was a little more hesitant and maybe a little more, what if it's different this time? So that's my general consensus, but I don't know what you think about that or what's it been like so far from your perspective.
Yeah, I've seen the market crash before, but COVID is the most recent one for me for the big dip. But my net worth wasn't as high as it is now. And, I recently got married. And so my net worth basically doubled overnight, literally.
Mm-hmm.
And so watching it tank that much, I was like, ooh, that number hurt. That hurts a lot more than it did 5 years ago when my net worth wasn't even close to six figures, let alone now it's at 500,000, over 500,000. So like it hurt a lot, but it didn't it didn't hurt in a way that made me want to do anything about it. Like I just know I'm not going to sell. If I sell right now, that means I realize those losses. Like I know this, but I think us in the FI community, anybody who has personal finance knowledge knows not to do that, right? But it hurt because I dipped under the 500,000 point. And when you're at like those goals where you're like, oh, I just reached 500,000 and I'm getting up there, and then you go back under, it feels like going backwards. And I don't know how you combat that feeling of going backwards. How do you think about something like that?
It's interesting you asked that because as you were talking about it, I was combination of listening and then I was also thinking back to my own experience because in this scenario right now, I also fell back under a net worth milestone that was like, oh, and it's okay. I know it's going to come back. It's fine. When I go back several years, I'm trying to remember which fall, which crash, which whatever it was. Ironically, I think it was the last time we were dealing with tariffs between the United States and China over like soybeans. And the only reason I really knew about that at the time was because my father-in-law is a soybean and corn farmer. And I watched my net worth back then, or my invested assets anyway, go from like 40 down to like $97,000. And it was like, no, it was just something about crossing that mark. And I think this probably just tells maybe a broader and greater story when you think about the power of gamification. And like we are wired to keep score. At least most of us are, right? That's why football's fun. I know you're really big into sports, Megan, but that's why football's fun for normal everyday people in the FI community, unlike you. But there's a scoreboard. It matters what happens. The better of the two teams wins. And I think that's why our Fitbits are fun. That's why our monitor tracking apps are fun, right? So I think it just kind of ties back into that. And even though we know this is one of those, we may be losing the battle for the moment, but truly we're winning the war kind of moments, there's still a scoreboard and it hits. So I don't know, does that make any sense to you or resonate with you at all?
Yeah, it's like if you were scoring your life, the big numbers you look at are probably health metrics, right? And financial metrics. I can't think of other metrics at that. Maybe like work stuff. I don't know. Not for me and not for us in the FI community. We don't care that much about that. But yeah, health and finances are your life score, right? But should it be? We always say you shouldn't tie your self-worth to your net worth. And that's kind of doing that if you're using it as the score for your life. And I think, but like you said, it's hard not to because it's a number and it's easily quantifiable. And so you can put that number, an easy number to identify to your life and say, my life is going well because of X, Y, and Z number in my bank account. And I think for me, the mindset shift that needs to happen is that I'm not going backwards. I'm being given an opportunity to get more shares because I just saw somewhere, and maybe it was in one of our WhatsApp chats where somebody said it's not about the amount invested, it's about the number of shares. So, meaning it's not the dollar amount that matters, it's the number of shares you own that matters. So now I have the opportunity to own more shares of what I already have, which is of course like VTI, VTSAX, or an S&P 500 in my 401k, whatever. I don't have cash sitting on the sidelines so that I can buy in at market dips. I just don't do that. Our cash is very, very specifically going to be used for things and it should not be invested. And then literally everything else is invested if it's not real estate. And so my strategy is that hopefully I get paid during this time. And we joked because I got paid today, which was the time when the market kind of rallied. And I was like, dang it. But luckily, my husband got paid last Friday and got into that dip, but he wasn't quite at the lowest point. But that's how I think I need to see it is doing it that way. But it's, you got your monkey brain in there trying to tell you what to do.
Yeah. If there's anything in there that's maybe worth circling back to that really make the difference, I think, is you talked about not having money sit on the sidelines that you can turn around and invest, right? And that is the quote unquote correct way to operate, is to always regularly and often be investing. And then we hear this in the FI community all the time when people have a moment where they come into money, whether it's an inheritance or the sale of a business or they sell their house and they're going to go rent or whatever. The common question comes up, what do I do with this lump sum? Do I invest it all at once or do I do it over time? And I am a textbook lump sum investor. I've had opportunities to lump sum a number of different times. And that's what I did this week as well. And funny enough, by the way, you did miss your payday being a day late, but the market shot up. The real story here is it collapsed pretty hard. And then the next day or a day later, I forget which it was, the market shot up and it finished up about 9.5%. And I'd actually text you and said, I'm actually going to market time for this one instance, and I'm going to hope that the futures trade tonight lower and tomorrow the market will open lower. And lo and behold, not only did it open lower, but it closed even lower. So when you got paid today, you actually only invested about maybe 3% higher than it had been before that big shoot up because it dropped again. So you did get some benefit. So it really tells that story of timing and how ridiculous timing is. And one more thing on timing, and then I want to go back to your shares comment because I think there's something cool in there. The only reason I hadn't invested this money yet, it's kind of funny. So the day prior, I actually dumped my entire emergency fund into the market because it was really low. And you're not supposed to do that. That's breaking every rule. But I had already seen an ACH confirmation that money was coming to me the next day that would replace all of my emergency fund and then some. So I dumped every emergency fund dollar in. And I actually walked upstairs during lunch and told my wife, I was like, oh, hey, Liz, by the way, I wiped out our bank account today buying stocks. Don't worry, it'll be back tomorrow. And she was like, okay. And we went on. So that's not advisable, but I really want to take advantage of it because
I would kill my husband if he said that to me. I just have to say, I would kill him. I'd be like, Christopher.
yeah, it's just, I guess it tells a tale of kind of how our money dynamics are. And again, I literally had an email that says your ACH is coming tomorrow. I know it's coming tomorrow. I know the source of the funds is very good. There's literally no concern. And I do have other liquid cash. It was out of reach. It would have took time to get there, but I did have another substantial amount of liquid cash, like 4 months worth of liquid cash. Okay. So it's not like I had nothing. It was just out of reach. But back to the shares thing. I don't know if I put this in our chat group or not. I can't remember. But a friend of mine, his name's Brandon Johnson. He's okay with his name being shared. He goes by the positive energy guy. He's all over Choose FI. He sees these down markets in a way that I'd tried to articulate, but I'd never been able to. So he's in a situation where he's got to get a lot of money out of traditional IRAs and into Roth IRAs because of required minimum distributions. He sees these down markets as a moment to do exactly that. Let me convert as many shares as I possibly can, even if it means taking a little bit extra of a tax haircut. And that's what he did. He originally had filled up his, I think he said 22% bracket, and then he bumped up and filled up his 24% bracket just because he wanted to take advantage of the market being low to get more money out of that IRA and more available for him in the Roth funds.
Have you noticed people's reaction to this market dip? Like, because I noticed hers was like, I asked her what she's doing, and she said that she keeps money on the sidelines to buy in at dips. And I was like, you should not do that. And she was like, yeah, but I get to buy this dip now. And I'm like, yes, but when you look at this dip now compared to maybe 4 years ago, it's going to be that 4 years ago is lower than probably this dip is. And have you had that cash for that long? So you could have actually bought it even lower back then. So I know it makes sense and everybody says buy the dip, but that's you can't do that because you never know what dip is the lowest dip. And so you have to just keep buying the dips and buying the highs and just keep at it, dollar cost averaging. There's a reason why people do that. It all comes out in the wash in the end, and you get the best return you could possibly get without timing the market, because timing the market is impossible. There are analysts who can't do that, you know? It's like, I forget the stats, but it's like 10% of the people who work in Wall Street can actually time the market to any sort of success. And I think it's pretty much 0% who can do it for long term.
Bingo. That's exactly it. You nailed it. I don't know if the 10%'s right. I just know that the number that beat it this year and then beat it again next year is minuscule, unless your name is Warren Buffett. And that's just the reality, right? So yeah, the timing thing is interesting. I will say this, and I don't know what JL Collins or some of the OGs of the FI movement would say, but the one way that I would accelerate my buying of the dip, because I did do that, is dollar cost average in via my 401k. And I have to be careful because I'm always trying to max out my 401k. And if I max it out too soon, my employer will not true up and match my funds as I continue to earn throughout the year. So for me, I would always know going into a year, how much extra can I put in to then be able to back off to make sure I get my 4% the rest of the way. And in many years, I was able to do that because the market, for whatever reason, it seems to like to fall between February and May. I don't know why that is, but it always seems like that's when there's a 12 to 20% fall, crash, whatever. And I'm like, dang, let me get some of that. And I start moving as much as I can in. But on the flip side, you talk about having to time it twice. I also dump all my Roth IRA money in on January 2nd every year. I do it on January 1st, but the transaction doesn't work. So it's a holiday. So like overbought in January in those years, and then was able to maybe true up when the market dipped through my 401k. So it's hard to pull that off. But to answer your actual question, what am I hearing or seeing from people in the community? So I know you're off Facebook and out of some of these groups. I am in them and I enjoy watching it. It's all over. But the classic always happens time and time again. Somebody asks the question, should I buy this dip now? I know I shouldn't sell now, but I was thinking about doing this decision, but now I'm scared. And then you see comments anywhere from 5 to 10 of them up to 100, depending on how much of a nerve it struck with the crowd. But the advice and the feedback is always the same. They ask the question, how far are you away from retirement? What was your plan? Is this still your plan? If you're that far out, why would you change your plan? If you're going to change your plan, it shouldn't probably be to sell out of your plan. You might want to buy your way towards your new allocation plan if you may have one. And people are just all over the place. But I think to make this as real as we can, we may have to go back and forth quite a bit here on this. I think there's always an opportunity to say, but this time it's different. And this time is really interesting. I mean, it's interesting. It's scary. It's unprecedented. It's never been seen before. But then again, so is COVID. But if I'm being honest, COVID did not scare me when it came to investing. For some reason, I was just like, this too shall pass. I don't know what it is about this that has me a little more on edge, but I still ended up in all equities with all of my investments. So do you think there's anything you're seeing in the community or anything with this actual event that makes you feel like it's any different? Or are you just like, meh, it'll pass?
Yeah, there was somebody in our WhatsApp group who said the same thing. This feels different. And I said to her, I was like, you're right and you're wrong because it is different, right? Because we're in a new year. We have a new person doing things that he shouldn't be. And so that's different. But what's not different is the underlying principles of what the American stock market is. And so even though this person who is running our country is making horrible decisions, it's going to always go up eventually. And we saw that. I mean, he literally put a 90-day hold on it and it shot up almost 10%. And I will say, I wouldn't even call this different because we've had trade wars before. And I believe even in his first presidency, I'm pretty sure he raised tariffs or tried to do it as well. And I bet the markets had the same reaction. I just don't remember because it was a long time ago. And I'm not even sure I was invested at that point because that was 2016. I'm not sure I was invested yet, so I didn't care. And so it is different and it isn't different at the same time. And I'd even say COVID was very, very different as a phenomenon, unless you count the Spanish flu, back in I want to say 12,
Let's go.
10, something
Let's
like
go
that.
with that. Sounds great.
Yeah, one of those years. I forget the year. But again, the market showed us that inherently the principles behind what the stock market is won't change regardless of what happens in our country. We would have to be really, really bad off for that to happen. And at that point, we're not going to be worried about our stock portfolio. We're probably going to be worried about where to get water, and food. If the zombie apocalypse happens, which by the way, we're watching Walking Dead again, Chris and I, and I'm like, man, that is a rough life. And they never give Rick any breaks. But anyway, if that happens, Rick, Michonne, they don't give a crap about their stock portfolio anymore. So yeah, that was one reaction that I saw was on LinkedIn. And I know I'm not on social media, but I am on LinkedIn. And I follow Tori Dunlap, and she was talking about the dip, of course, because she's a personal finance, guru in our space. And one guy mentioned, he was like, how do you talk to people who are in their 70s, retired and living off their portfolios, and they just saw it dip hundreds of thousands of dollars potentially, and they have to live off this money? How do you square the advice you're giving to those people? And emotions should not be downplayed in this. You should be allowed to feel your emotions. Absolutely. Especially if you're in that situation, right? Because it's regardless of what your portfolio is, even if it's, 60-40, 70-30, you're still going to see quite a dip in that regard because it's still a big portion of it's in stocks, right? The thing is, you can feel the emotion without letting it change your goals. right? If you had this plan, which this person's parents at the time have their plan with an investment, like banker, mutual fund guy, whatever. So that's a different story. But regardless, if you don't let it change your plans, that's where you win. If you do allow your emotions to change your plans, that's where you lose. It's not that your emotions aren't there and aren't valid. It's what you decide to do based on those emotions. So, yeah, there was a lot there. So, what do you think?
The end of that was very deep and really well articulated.
It's called therapy.
So it's really interesting. So I think why not just name Scott Trench, the CEO of Bigger Pockets, the host of the Bigger Pockets Money Show? He's a brilliant guy. And he's the individual that I was referring to in this space that's been talking a lot about a portfolio change lately. And he went and put his money where his mouth is. He's got this new take that if you're in 100% equities and you've hit your FI number, his argument is you're not FI because you're one big market crash away. Because being FI based on the 4% rule is based on a 60-40 or a 70-30 split of stocks to bonds. And he decided for him what was best is once he'd won the game of life, why keep playing? And so he, as like a 34-year-old man, sold his stock portfolio down. So now he's at 60% stocks, 40% bonds, and he pulled even more cash out and bought a rental house in cash to let his rental house act more like bonds even to give him a regular and recurring, always and often cash flow. And I say all that because Scott thinking like that retiree should have been thinking in advance of their retirement. Your glide path's an important part of the plan. I can't imagine being 60 years old in 100% equities. I think 60-year-old Mitch is going to be in a different spot. But 39-year-old Mitch is technically FI, yes, but it doesn't scare me because I'm willing to outwork my problem. I'm willing to outwork that first 5 years. If all of a sudden we took a 40% or a 45% dip or something, I'm willing to do that. The second thing that kind of helps me, I do have 33% of my financial independence number comes from rental property income. And that's based on after setting aside money for long-term expenses, vacancy, and all that stuff. 33% comes from that and interest income. That's not subject to the stock market. So then I feel like if I can get 33% of my income from it, then I only need to come away with the other 70% from my stock portfolio. Well, I was able to figure out that without selling anything, I can come up with about 55 to 60% of my need just with my rental property income, my interest income, and then dividend income if I didn't sell any shares. And I thought, okay, that's much more palatable. Because the other side of the coin is with my real estate, I don't take out all the cash that I bring in. That cash flow is true cash flow. But if I set aside money, which I do, for a roof or a furnace or whatever to be replaced, what are the chances that both of my rental homes, all of that stuff's going to go wrong in 1 year? So the money's there to cover that. So in the event of a down market, I'm already, call it 65% of the way to my number. If I just took the rest of my excess cash flow, that doesn't count as my money because it's for long-term things for 1 year while the market's down and recovering, or 2 years while the market's down and flat before it recovers. That's a pretty good ballast. And it's not perfect, but you pair that with being flexible in your spending and it can really work. So going way back though to all the crazy stuff that's going on and what the president shouldn't be doing. I mean, there is no basis, no understanding that says that this is logical. I think we've seen some interesting feedback from some of the other countries that kind of makes you wonder a little bit what is going to happen next. Man, you said there was no precedence for this. There was precedence for COVID back in 1912. Let's go with 1912. You get some more ad revenue and we can afford a statistician. Can you get on that? They can tell us what year this happened. The last time there was a major tariff attempt, it was in the realm of and helped shake and create the Great Depression, which is really crazy and scary to think about. That's the last time it happened. Now, somebody might have to fact check me out there, but I'm pretty sure that's accurate. So is it different? Certainly. Have we seen it before? Maybe. There is an argument to be made that when you look at earnings per share multiples, meaning for every dollar earned on an individual stock or index's share, how many times over are we buying that? And the market does need to break once in a while. That's healthy. It's supposed to happen. So it's like last time it was COVID. This time it's tariffs. the market technically needed to break by historical standards. We just didn't know what was going to break it. So is this time really different? Maybe not. I don't know.
Yeah, exactly. Like I said, the principles behind what govern, if you can even call it that, because the stock market's a wild beast, but whatever governs the wild beast are the same. And also, we are not trying to scare anybody about this tariffs thing leading to the Great Depression. There were definitely a lot of other factors that led to the Great Depression that are no longer a thing. For example, buying stocks on margin. You can do that, but they've put limits on it, like really, really, really tough limits on that. So they can't do it at the same level that they used to do it back then. So just want to ease people's minds.
Thanks for doing that.
But
Was not my intention at
yeah,
all. It was just like, is there a playbook for this? Thank you for saving the audience
yeah.
from this dummy on the other side of the mic.
It's one of those things where the market's going to do what it's going to do. And as long as you are, you stick to your plan and you have your investor statement, which I love. I'm pretty sure Brad said somewhere that he was like, this dip had me wanting to go completely against my investor statement. I forget where I saw he said that, but I understand. Like it's super scary and, it's not something that it, even though there's precedent, even though it happens, even though the market corrects, like I said before, it's okay to feel afraid. And it's funny because like I said, I at first felt, oh man, my net worth is now below that number. But then on the other hand, I was like, is there a way for me to take this opportunity to buy in? And so I literally did like an analysis of the cash that we have. And so part of it is Chris and I are building up our emergency fund. We have it at 3 months. We want to get it to 6 months because we're in the family planning mode. And so we want to get it to 6 months. We're like 60% of the way. And so that's cash. That's not going in because we don't have an emergency fund otherwise. But the other half of it is my HSA. And I just did an episode on this that I had to convert my HSA all from investments to cash equivalents because I'm paying for, fertility treatments and they're very expensive. And I actually just went over, the cost of this with the Duke Fertility Center here about how much it would be for a donor. I called my insurance company. They pay nothing when you get donor eggs. Nothing. Like you have to pay completely out of pocket. And just buying like the frozen ones is almost $20,000. Doing a live donor like we want to do is going to be about $28,000, like straight out of our pockets, right? But I didn't know that. I thought maybe insurance might cover some of this. So I, was like, okay, maybe I can invest half of my HSA back into the market. And I almost just did that, like making the assumption that, oh, my insurance is covering everything now. Let's just do that. And I'm so glad that I called them and said, hey, actually, what do you cover? Because that would have been a horrible idea. So I'm really glad I did not do that. But I'm kind of patting myself on the back a little bit for having that mindset to begin with, because there's so many people who are like, I want out. I want to get out. I want to get out now. Oh my God, oh my God, oh my God, it's crashing. And I'm like, ooh, I want to get in. I want to get in. Oh man, I can't get in. And I just think that's the FI mindset. And I love that we are that way. We're little weirdos. And I love that about us. But that's also why we're all millionaires in our 30s. Well, I'm not quite there. I'm almost there. Yeah.
Your day will come. It's like frustration of missing out, not fear of missing out. That's what I saw when you were like, I want in. You know what's interesting? This is not directly reflecting to what you just said, but it kind of has to do with buying the dip. And I think it's an interesting thought experiment that I landed on this morning. I don't know why it hit me, but I realized a lot of us are straight up VTI or VTSAX investors where we just own the total stock market and nothing else because it's easy. And that's what I did up until last year, September 2024, I think is when I made the change. I switched from having just the one fund or a series of total market index funds that I owned in a few different locations because I had 401ks, IRAs, whatever. And I moved to 7 index funds across 7 different sectors. And I know you, Megan, have talked about it. And it was complicated. It wasn't your jam. You decided to move on. So what's interesting is here's what happened to me. So I had this deposit come in this week. I had wiped out my emergency fund the day prior. So I got to buy with that chunk nice and cheap while the market was down 2 or 3%. Then the next day it shoots up. And what was interesting was I was just waiting for my money to settle so I could do something with it, get it into Vanguard and be able to invest it. And as soon as it arrived, I was going to put it in. I all of a sudden log in and the market's up 8%. And I'm going, what on earth happened? So I quick Google it, and literally 10 minutes prior, the president had tweeted that he was pausing tariffs for 90 days. I'm like, you have to be kidding me. Like, what are the chances of that? So like I said earlier in the episode when we were chatting, I let it go. I'm like, whatever, I'm going to trust that tonight what's going to happen is cooler heads are going to prevail. Some people are going to, they call it profit taking for the audience, that where they say, you know what, the market shot up, I'm going to take some chips off the table, and they sell. And then people like me get to swoop in the morning. This is classic, unscientific, taking a shot at market timing, and it happened to work out. But here's what's crazy. I woke up this morning and I'm looking, I went, well, wait a minute. I haven't rebalanced my portfolio yet. And that's how rebalancing works. You sell your winners and you buy your losers. And so I went and I looked at my asset allocation. I realized I don't have a spreadsheet for it. So I had to create one this morning to figure out how much money do I have in small cap value? How much money do I have in REITs? How much money do I have in large cap blend? And what turned out was I had too much technically for my asset allocation target. I had too much in VTI and too little everywhere else. And so I got to buy all those other funds between 14 and 22% off of their all-time highs. And it helped me rework my way towards my target allocation. So for anyone in the audience who's thinking about, can I buy the dip? Maybe, maybe not. But could you reallocate your way into the dip? Potentially. And if it's inside of retirement accounts, there's no tax consequences. And in my case, it was with new cash. So yeah, that was my random story that just happened to work out for me. And yeah, the market still ended up going down like 4.5% today. So I'm pretty sure I bought and then my stuff fell because I buy ETFs. So the moment you buy, you own it at that rate. Or if you buy the mutual fund, you get the end of the day price. So, it is what it is. I timed fine. I'm happy with it. It's going to work out. And in 20 years, I won't know the difference between whether I bought at $202 a share or $194 a share. It's just part of the game. So
Yeah, it's just going to be a day in history. And, we might not even remember this, right? It might be like COVID, we're going to remember. And even though that dip really didn't last that long, and I actually have a really good story about that, a really vindicating story. This is before I met Chris, right? So we met in 2021, and this was March 2020 when COVID hit, market went bloop, and then shot right back up, right? Not too long after. I forget what the timing was, but it wasn't even a month, I don't think. And so I was dating a guy at the time, and by dating, I mean like going on dates here and there. He was kind of a jerk, so like I was probably going to let him go at some point. But he started arguing with me about like buying into the market, and he's like, I'm going to wait because I think it's going to go lower. And I forget the day that the market bottomed out, but this was that day that he was telling me this. And I was like, you don't want to time the market. I was like, the market is crazy. It'll do the most unexpected thing. And he's like, yeah, but this is a pandemic. We've never seen this before. It's different. It's going to go lower. And I was like, I really don't think it is. I think if you've got money, put it in now. Like this is pretty low. And he was like, well, my friend who's a business owner and a millionaire told me not to. So I'm not going to listen to you. I'm going to listen to him. And I was like, okay. And then literally the next day, that's when the market starts going like this. The next day goes like this. The next day goes like this. And I'm like, so how's it going? Totally ghosted me. He ghosted me. But I was like, man, I didn't get to say I told you so. But anyway, you never know. The market loves to do its own thing. Like it is like the most bipolar, emotionally fraught thing that you could ever think of. So might as well get in now.
my decision to market time, this was yesterday, literally, my decision to market time and go, you know what? I think this is probably what's going to happen. Again, completely unscientific, but I do watch the market every day. And that doesn't mean I was going to be right by any means. But what I find to be really interesting is for whatever reason, this seems to happen where the market goes up, people get excited the next day, it sells off. But back to what you said, like the whim is crazy. Like 2 days prior, there was a fake tweet or something that went out that said Trump was going to pause tariffs. And the market shot up by like 3% in 6 minutes and then fell 7% like a minute and a half later because they realized it was a fake tweet. And you have no idea what it's going to do. You have no idea when it's going to do it. I wrote a note down that I forgot about from earlier that I think might be helpful. We keep bouncing back to COVID and today. And the mad scientist talked about this back in the COVID time. He doesn't do many podcasts anymore. He's not super consistent on it, but he did his own podcast and he went on a couple of other podcasts talking about how he was documenting and writing down and journaling how he felt during COVID, because COVID, I think, fell about 34%, if I remember right. And I think just like you said, like, whoa, that's a number. Like before when it fell during COVID for you, you're like, eh. And now you're like, wait a minute, that's a number when it dropped. I think that's what he went through too. And he's never disclosed or declared if he's made any changes that I'm aware of. But it's interesting that he did document that, he did think about that, and I'm guessing he's just trusting his math. That's essentially what I did. I do technically have it written down, but it's very simple. And that's essentially what I fell on, was that math, and this too shall pass. And I remembered, like, my biggest fear, what actually scared me this last couple of weeks when the market tanked, what actually scared me was just like, I went from telling everybody I'm FI to technically you could argue I'm not because the market fell, but I own the shares. I do own the shares. The question is, when will they go back to the number that I like? And the average timeline it takes to recover from one of these is like 10 months. 10 months. Like that's like nothing in the grand scheme of things. So I don't know if that helps anybody out there, but I wanted to circle back to that.
Yeah, that's good to know because I didn't know that. I didn't know how long it takes to recover. When you said 10 months, I was like, that's a long time. And then you're like, that's not long at all. So it's kind of funny how we think about stuff differently. But I guess I also, okay, so if there's anybody listening who maybe is like, why does it matter that you own the shares? Why doesn't it matter that it's the total dollar? Just in case, I'm sure everybody knows this, but I'm going to say it anyway. So I'm going to give a really bad metaphor for this. But say you own 10 t-shirts and they all are you bought them at $10, right? And then those t-shirts go on sale for $5. And you know that the t-shirts eventually will also become $20 one day, as long as you hold on to the t-shirts long enough. Would you buy the t-shirts at $5 knowing that they're going to go up to $20? Yes or no? So that's shares, right? So the shares are the t-shirts, and the dip in the market is the t-shirts going down to $5. And the market, going back up again is the t-shirts going to $20. So the market always goes up over time, always, even with the Great Depression. Now, it might take time, but if you buy the t-shirts at $5 and you hold them and don't sell them for $5 or even $10 and hold them until they're $50, $100, look at all that money you're making. And so I just want to put that out there just in case anybody's like, why does it matter if it's shares or not? So
I dig the analogy. I was picturing a couple of my favorite shirts while you were saying it and thinking like that shirt to me is worth $10 and it should have cost $20. I would have paid $20 if they would have charged me that for it because I like that shirt so much. But yeah, I think it's a really good explanation.
also, if anybody just saw a cat jump on my chair, that's my cat, Bernie Sanders. And yes, that's his name. And if I'm on YouTube a lot, you will probably see him because I'm always in this guest bedroom and he lives in here because he fights with one of my other cats. So he's always with me when I record, jumping on my head because he loves me. Bernie Sanders loves me.
I remember what I was thinking when my brain broke for a second, but now that you brought up the Bernie Sanders, do you remember those pictures of him wearing the mittens and they like put him in front of everything? There are memes all over the internet of it.
Yes, he's like this. And
Yeah.
he's basically looks like he's napping.
Yeah. Yeah, that was
Yeah.
great. There was one where he was like making a clay pot like from the movie Ghost, but anyway, that's a whole different story. So what I was thinking about is you said 10 months is a long time. That is such an interesting just life view. I think 10 months is nothing. You think 10 months is forever. But I would just think of it like this. I know you recently talked about like the hope of reaching coast or half fi and thinking about these part-time work jobs. It's like if you only had to cover your expenses for 10 months, like sure, if you had some travel plans, like that might stink. You'd have to figure out how to make that work. But if you didn't need to worry about that aspect, and you're just kind of living your life in your town, taking your, family, your kiddo to and from school, all that kind of stuff. And now you just have to work part-time during the day. Like, that's not so bad. That's what I call a pretty good miss.
I mean, I will say that part of it is where I am in my life right now. Like, I'm living day by day. Like, right now, I'm waiting to see if the last round of IVF stuff worked. And it's like every single day is taking forever. And so that's why I think it's just perspective for me right now. Just, it seems like time is going super slow. Anyway, I have exhausted what I wanted to talk about with this. I don't think there was anything else I wanted to bring up except just, if people are out there and they need some, calmness to bring them out of this fear. I'm going to link in the show notes JL Collins. I hope he still has
He
it up.
does.
He has this. Okay, great. He has this meditation. And if you guys have never heard JL Collins' voice, it is the most calming, deep, amazing voice ever. I want him to just read me stories at bedtime because it puts me right to sleep. Not because he's boring, but just his voice is so relaxing. But he did this meditation on when the market is crashing. And it's so good. It even has the calming, massage yoga music in the background. And I think it's like 10, 15 minutes. It's really good. So I will put that in the show notes for anybody who needs to listen to it.
Yeah, I'm sure you're going to ask me if I have anything more. And that's literally what I was going to bring up was that guided meditation because it's so good. And I remember where I was when I first heard that during the whole COVID scare and everything and driving from point A to point B. And I'm like, I could take a nap right now. And I also want to buy more index funds. This is amazing. So yeah, this is unique. I know we didn't plan to do this, so I'm glad it worked out for us to just make our schedules align, get a chance to sit and gab about this, think about our feelings out loud a little bit and our observations of the world, and hopefully set people up to be ready for the next one. And I mean, who knows, this thing could take another leg down and all of a sudden we record another episode that now this time we're actually scared. I don't know, but I don't think that I will, and I'm guessing that you won't be either.
Nah, I won't be scared. And yeah, to leave us off with a nice, lovely quote from Jurassic Park. Hold on to your butts. Thanks for listening to the EverydayFI podcast. If you're loving the show, here are some things you can do. Number 1, subscribe in your favorite podcast player and share the show with your friends and family. Number 2, please leave a review. I'm always looking for ways to improve the show. Number 3, check out my website, EverydayFI.com, where you can listen to all the episodes and leave comments for myself and the guest. Number 4, if you're interested in sharing your own financial independence story, you can find a submission form at everyday-fi.com/podcast. And finally, number 5, join my Patreon membership for only $5 a month at patreon.com/everydayfipodcast. This is a one-woman show, so every little bit counts. See you next time as we continue to go down the path to financial freedom.